Welcome, dear participants of our session on the generational impact of monetary policy and inflation. It's a great pleasure for me to be able to welcome Professor Jordan on this panel. You all know him. Professor Jordan has been the chairman of the governing board of the Swiss National Bank for more than 10 years already. He's been with the Swiss National Bank for more than 20 years, joined the governing board in 2007 and started as a chairman in 2012. He has experienced interesting times during his tenure. We'll get to talk about that. And I'm glad that we can today discuss with him some of the issues that the Swiss National Bank has to handle on an everyday policy on monetary policy and inflation. My name is ManuelAmman. I'm a professor of finance at the University of St.Gallen. I have also the honor to be the next president of the University of St.Gallen, and I'm now very pleased to be able to discuss with Thomas Jordan on generational impact on monetary policy. Professor Jordan, for the longest period of time during your tenure, you had to fight deflation. You were concerned with situations where inflation was not a problem. And now all of a sudden, the ghost of inflation is back. And we are dealing with a situation that is completely different than that of a few years back. Luckily, Switzerland seems to be in a very comfortable position, at least in relative terms, if we compare it to other currency areas. Have we successfully, or have you, I should rather say, have you successfully fought inflation already? Can we go back to a normal situation of maximum 2% inflation soon?
Well, Manuel, inflation still is an issue in Switzerland. So this morning we just had the newest figures. It's 2.6. This is, in an international comparison, a very good level of inflation, but nevertheless it's higher than what we would like to achieve. For us, price stability means below 2%, but positive. And the fight is not yet over. So we have to be very, I think, determined to bring inflation back to price in the range of price stability. And we will do everything that is necessary to go in that direction. We will have our next policy meeting in a few weeks, in mid-June. And of course, everything is open. We will look at the newest inflation forecast at that time. We will consider everything together, and then we will decide on monetary policy. We always stress the point that we cannot really exclude that it will be again necessary to further tighten monetary policy, really to make sure that inflation goes back into the range of price stability. Underlying inflationary pressure is still relatively high, relatively for our ambitions, and we will look at that very carefully.
Of course, you're not going to tell us whether you're going to rise interest rates or not, but if you're looking at the spread between interest rates in Switzerland and interest rates, in the dollar area or in the euro area, there we are at 5% now. We are at almost 4% now. Switzerland, we are still at 1.5%. Now the spread is quite large, so there is enough leeway still for the Swiss National Bank, I suppose.
Well, traditionally, interest rates in Switzerland are much lower. And you should not only look at nominal interest rates, but also at real interest rates. And of course, when you have an inflation rate that is above 5% and one that is just above 2%, then nominal interest rates cannot be on the same level. So I think we have to look at those different interest rates with the view, what is the inflation here in Switzerland, what is the inflation abroad, and what is the traditional, more or less, equilibrium of interest rates. So these are all very important elements to make a judgment about whether monetary policy is just balanced, whether it is effectively restrictive or not.
In Switzerland, we have many administered prices, and administered prices have the property that they don't react immediately, but once they react, they're very sticky, right? So how concerned are you about such second-round effects?
Well, second-round effects are, I think, very important, and we expect that we will see more second-round effects in the future. We already saw some second-round effects. I have also to say that maybe this is a little bit exaggerated. So I think also many prices abroad are not completely free and also administrated. And this is true for Switzerland. We had a little bit luck that the part of energy within the CPI is smaller compared now to maybe the rest of Europe or to the US. So the impact of energy prices on inflation was smaller. But I think the rest of the prices more or less has the same flexibility. But what we clearly see is with the inflation going up, we will see more second-round effects. And what we saw is also that the behavior of firms completely changed. So for a very long time, firms hesitated to adjust their prices. They feared that they will lose clients and customers, but they also did not accept higher prices from their suppliers. And that behavior changed completely. So firms are more willing to pay higher prices when they buy goods and services, but they really have no hesitation then also to increase their sales prices. So the entire dynamic in the price setting changed, and obviously that makes it more difficult. So it's a little bit less stable, and this is also a signal that we will see probably for some time these second-round effects, and we have to account for that, and also to make sure that we really go back into the range of price stability.
Why are you so concerned about this price stability of the inflation being below 2%? I mean, obviously, it's your legal task to do that. But many, well, maybe not that many, but let's say a few economists argue nowadays that perhaps inflation rates could also be anchored at 4% instead of 2%. And this would not be a tragedy, right? This would foster more growth, right, in the economy. What do you say about that?
Well, I do not share this view at all. So first of all, we have to mandate price stability, and 4% is not price stability, an inflation rate of 4%. But I'm deeply convinced that price stability, low inflation is something that is beneficial in the medium to long term for the economy. So the price signals are much clearer when we have low inflation compared to a situation where inflation is 3, 4, or 5%. So it is really something that avoids misallocation of capital. It avoids also decisions that were taken on a false assumption. So this is one thing. But the other thing is also it's also an element of fairness. So we know exactly that when inflation is high, when we do not have a state of price stability, it is always households with low and medium income that suffered most. So in order really to generate the biggest contribution of central bank can make to the well-being of ordinary people is really price stability. So many people cannot protect their income when inflation is higher. They cannot make the right decisions when they are impacted by inflation. So inflation or price stability is also, from that perspective, extremely important. We saw that also now in the last couple of months or in the last 2 years. For a very long time, inflation was not an issue. So we had exactly those discussions where we say, well, it would not be bad to have 4 or 5% inflation, it would be even better. But as soon as we had a little bit inflation, we saw the social problems that started to arise. And I think today everybody would be happy to have, again, low inflation because it really creates tensions. It is unfair. And we have to make sure that central banks really can contribute also on that front with price stability.
Now you're touching upon the question about the distribution of income in the long run, right? And this is the topic of today's session. What monetary policy can do for the people of a country in the long run, or how monetary policy also fails the people in some respect, right? You mentioned it about high inflationary policy that is particularly bad for the poor. Now, with 2% inflation, within one generation of 30 years, people are still losing 50% approximately of their purchasing power, right? Still, even with our current regime of a maximum of 2% inflation, the Swiss franc would not be suitable as a long-term storage of purchasing power.
Well, this is true, but on the other hand, we have to see that measuring inflation is not completely trivial. So often when we measure inflation, let's say 2%, maybe actual inflation is a bit lower. So there's a long debate whether there's a bias in measuring inflation. So at least for some time, it was I think the conclusion was that measured inflation slightly overestimate true inflation. So this is also one reason to have not exactly a zero target for central banks and monetary policy. And on the other hand, we also see that maybe the functioning of the economy is slightly better when we have very low inflation but positive inflation. Just to give you an example, when you have to adjust wages in a firm, when you say, well, we have inflation minus 3%, so a kind of a deflation, is, well, okay, we keep real wages constant, we have to decrease nominal wages. So this is always a very difficult task when you have to tell the people that they should have lower nominal income just to get to the same real income. So the functioning of the economy is also, I think, clearly, it works best when we have something between 0 and 2%. Then we have none of these kind of nominal real problems, but we have a really, I think, a very stable situation where most people and most firms do not have to bother about inflation. So they can take the decisions without taking inflation into account. And usually the compensation for, I think, most financial decisions should be such that they should compensate for this 2% inflation. So that should not be a too big problem. But if you have volatile inflation, if you have high inflation, then of course this is a completely different story.
So you're talking about money illusion and sticky wages, and use that as a justification that you need a little bit of inflation. Now, the question is, how do you govern? How do you manage this inflation? And we talked about interest rates already, right? The interest rate policy, but obviously there's also another way, right? That is exchange rate. Exchange rates could also be used for that person. Can you elaborate on this a little bit? Which instrument you give what weight?
Well, let me maybe start just by explaining a little bit what we mean by monetary conditions. So the way monetary conditions have an impact on the economy and on inflation. And in Switzerland, I think the lion's share of monetary conditions can be explained by the level of interest rate and by the exchange rate. And of course, then it's also the real interest rates and real exchange rate that matters most. So we are small and a small open economy. So obviously the exchange rate has a big impact on demand for exports and imports, and through that on inflation as well. So we have to look obviously at the entire situation in order to have a judgment about how to conduct monetary policy. So our normal instrument to set monetary policy, to set the level of monetary policy, we use the nominal interest rate. So this is the S&P policy rate. We are discussing the policy rate every quarter, and then we are setting it to keep it at the same level, increase or decrease. Obviously, when we had to go into negative territories with the S&P policy rate, we also had to go to the other instrument to use interventions in order to balance a little bit monetary conditions in order to avoid a deflation. So during a relatively long period, we used interventions as a tool to avoid an overly restrictive monetary policy in order to maintain price stability. And this is an instrument that is not the main instrument, but it is also available for us. Now the situation changed. We have now a positive S&P policy rate. We do not buy at the moment for an exchange. We rather sell at the moment, but we can use it as a complement in order to make sure that we have the appropriate monetary conditions so that we can achieve our goal of price stability. And this is something that is also helpful under the current circumstances.
Could you not do that also a little bit more aggressively? I mean, you have this huge balance sheet. It's been criticized. You have reported heavy losses for last year, right, because of the balance sheet. Wouldn't it be a bit more beneficial to make a more active use of this instrument to bring also down that balance sheet?
Well, the size of the balance sheet of the Swiss National Bank is the result of our monetary policy. So it was necessary to expand the balance sheet during a long period in order to avoid deflation and to support the Swiss economy. And if you look at the level of inflation and also the economy, I think that is proof that it was necessary to conduct this monetary policy. Now, for us, we have no target for the size of the balance sheet. So we do not say, well, we need to shrink the balance sheet now within a year or two by 10%, 20%. So we do not believe that this is a sensible target, but we can use foreign exchange interventions in both directions in order to support, I think, monetary conditions so that we can achieve our goal of price stability. And we are relatively transparent on the balance sheet in general, but also on the interventions. We are publishing now interventions every quarter with a lag of 1 quarter. And we just published the figures from the last quarter of 22. And during this quarter, we sold roughly 27 billion Swiss franc value of our foreign exchange reserve. So this is something where we can use. We will also continue to use as long as it makes sense in order to steer those monetary conditions.
Let's stay with the balance sheet for a moment. I mean, there are many good or less good usages of the balance sheet. One proposition that we have frequently heard in recent times is that the Swiss National Bank could perhaps make a better use of the balance sheet. We're talking about intergenerational contract. We're talking about future generations, right? Some people have suggested that you could use your balance sheet to fund a fund, right? Yesterday, the manager of the Norwegian fund was here, right? Norway has oil, we have the Swiss franc. At least that's what some people say, right? And both could be used to fund such a generational project to essentially fund a future generation with long-term investments, for example, in companies. I know you're probably not going to agree that this is the way to go, but what are the main reasons why you're saying that this would be a very dangerous path?
Well, this idea of a sovereign wealth fund funded by assets of the Swiss National Bank is almost like an evergreen. It's almost like an intergeneration project from politics. And you already said it, it's clear we do not like this idea. We believe it's based on many misunderstandings. And the comparison between Norway and Switzerland is really wrong. So Norway can invest the receipts from the oil production and gas production, and they would like not to spend all the money today, and they will do it over many generations. So the Swiss case is completely different. So the assets of the Swiss National Bank are the results of monetary policy. So we were forced to expand the monetary base in order to fight deflation, and that created these assets. And monetary policy will also define when it's time to let shrink the balance sheet, and then these assets will go away. So it's really the motivation or the source and the reason for those assets is monetary policy. And it's not something like an assets of Norway where they have really real assets that they sold. So it's completely different from that perspective. So this is one important element. So the comparison really doesn't makes sense and doesn't hold. And there are many other arguments. The other one is you cannot take away those assets out of the balance sheet of the Swiss National Bank at all or easily. So you have a liability side, you have an asset side, and we cannot give that as a gift to somebody else. So then we have a hole in our balance sheet. It's not, from a legal point of view, really almost impossible to do it without really harming the legal structure and the independence of the Swiss National Bank. Then a further point is there is always the view that then this fund could generate much higher returns than what we do as the Swiss National Bank. And this is also not true, except when you go on a much higher risk level. Then maybe if you invest everything in equity, if you invest in other things, more than we do, then you could generate. But then you have also more risks, and there is a question who should be then accountable for the losses. So now at the moment, as you already mentioned, we suffered losses last year, and it's clear it's part of our balance sheet. What would be the discussion if that would be in another fund, and the fund would then suffer 200 billion loss or something like that? So this is also undefined, unclear, and I think would be a problem. And the last point I would like to mention, which is really fundamental, these assets have a monetary policy impact, and when we change the balance sheet, it will have a monetary policy impact. And if somebody else decides on those assets, just if it's too much foreign exchange risk, we switch it into Swiss franc. If the fund would decide on those such a transaction, then it's like a counter intervention and has a big impact on our monetary policy. So you cannot separate that. So these are all, I think, 4 or 5 reasons that I explained that clearly say this is not a good idea. It would harm monetary policy, and it gives a false impression that you can achieve returns without going into a higher risk. So I think the idea is really based on misunderstandings, and these assets are fundamental part of the Swiss National Bank, of our monetary policy. They increase and decrease exactly really in line with the decisions we make on monetary policy.
Talking about the balance sheet and its impact on monetary policy, you have recently used your balance sheet for another purpose. You have given a fairly high credit line to a large Swiss bank on conditions that are, bluntly speaking, unusual. Because you're supposed to give credit lines to banks that are secured with good collateral, and now for a large part of that credit line, 100 billion Swiss francs, you do not have collateral. You just have a bankruptcy privilege. Have you gone too far?
No, we went exactly to the limit, but it was also necessary. I think it's not only an unusual lender of last resort transaction, it was also a very unusual situation. And authorities, Swiss National Bank, the Federal Council, and FINMA had to deal with that situation, and we had to come up with a solution within a few days in order to avoid a financial crisis that hit Switzerland, but probably the rest of the world. I think this is, the key element. It was necessary to avoid, a big accident, a big financial crisis, and the operation, all in all, was successful. So you rightly pointed out that we can provide liquidity assistance against collateral. Usually we take collateral in form of securities, mortgages, etc. Because this collateral was limited, we had to find another solution, and this privilege in bankruptcy case is a substitute for this kind of security that we need. That is also the reason why it's limited. It's not unlimited, why it goes up to a certain amount where we say this is sufficient in order to have the security that we need to give that liquidity assurance. So it's clear it's unusual. It should not be the normal. I think we will also make a suggestion that in the future banks should have more collateral be forced to have more collateral in order to make the balance sheet of banks more liquid in case it's necessary. But under the given circumstances, in March, I think it was necessary to deal with the situation, and we went exactly to the point that we are convinced is warranted by our mandate, and it was necessary in order to deal with the given situation.
Some people say that instead of coming up with these complicated structures, with supported by state guarantees, writing off AT1 bonds, and so on, a word of you, similar to what your colleague Mario Draghi did some years ago, just saying, we'll provide liquidity, we'll provide sufficient liquidity, whatever it takes, Credit Suisse will stand. Why didn't you do that?
Well, my colleague and friend Mario did that for the currency, not for a bank. I think this is a key, and you should see who is responsible for what. But I think this is really an important question, and we prepared all the necessary, instruments in order to provide the liquidity that could be or would be necessary in case of an emergency. But the problem with Credit Suisse was a lack of confidence, and just by saying, well, we will provide liquidity, you cannot address the key problem. And then the central bank would probably rather trigger the bank run by just saying, well, we are here to provide liquidity, and giving a signal that there are huge problems, and these problems are not addressed at the same time. So of course, if you have something else that comes with such an announcement, that could help. But for the Swiss National Bank, just to give a signal where there is neither a mandate nor the competence of the Swiss National Bank to say whatever it takes, and that would probably not be a good idea under those circumstances. I think it's also important that to see the Swiss National Bank can neither guarantee deposits. There's no legal instruments that we have that would demand for an act of parliament, or at least an act of the government in emergency law. So here the legal setup is different. And also, if you look at abroad, usually central banks do not, they provide the liquidity, but they do not take over banks, they do not save banks. This is something that is either done by a separate authorities or then directly by the government. So there was sometimes said, well, the Swiss National Bank should have taken over Credit Suisse, but this is something that would be incompatible with the mandate of a central bank, especially also a central bank that is not the supervisor of banks. If you would say, well, we could save banks, the same argument would then be valid for any other firm as well. So the Swiss National Bank could save Swissair 20 years ago, or all the electricity companies, etc. So we are here for the economy as a whole, but and then it's immediately visible that would be a terrible, I think, argument. If you take taxpayers' money to save firms, it has to be really a decision by the government and by the democratic elected institutions.
But still, during the tenure of you on the governing board of the Swiss National Bank, you have bailed out 2 large Swiss banks out of 2 large Swiss banks. So this is actually quite a track record, I would say. And the question is, what is wrong, right? What is wrong with the banking system that this had to be done twice in such a short time? Or rather, how can we, the Swiss National Bank is also in charge of macroprudential stability, right? How can we make the banking system more stable that this does not have to happen again? Now the situation becoming even worse with Credit Suisse and UBS merge. Okay, we don't know the ultimate outcome yet, right? What the structure will be, but most likely will be even a larger firm. And the question is, what kind of instruments would you need as a Swiss National Bank to ensure financial stability in Switzerland without resorting to emergency law, which undoubtedly is less than ideal, right? So what can we do in this respect? What perhaps alternative ways are there, or will there be, right, to handle such a situation? I mean, after the last bailout, after the last financial crisis, a lot of effort has been put in too big to fail regulation, right? And banks had emergency plans, and with the intent of being able to wind down a failing bank, right? And this has not happened, although it would have been a case for this instrument. So apparently the instrument was considered not ideal to deal with such a situation. So what instruments would be ideal?
I think this is an extremely important question, and authorities, but the public and also science will look at that very carefully, not only here in Switzerland, I think globally. I think it's a very important task. And but maybe just to elaborate on a few points, I think all the work we did over the last 15 years, they were important, and they helped us also under those circumstances. Obviously, especially the resolution issue was not perfect in a sense, but we have to say it was prepared. But under those circumstances, authorities came to the conclusion that going in that direction could rather trigger an international financial crisis. And then you have a cost-benefit analysis, a kind of a risk management, and you have to be clear what type of risks can you take under some circumstances. And the conclusion was to avoid going into resolution. And then the next best solution was the merger, which is in a way also a private sector solution, obviously supported then by the Swiss National Bank and by the state. To what extent actually public funds will be used for the takeover or the merger, that has to be seen. So far there are guarantees. Of course, there's a lot of liquidity from the Swiss National Bank, but we will see only in a couple of months exactly what is the result. So it was the idea to be as close as possible to this market solution, and also a little bit remain in the concept of too big to fail. Obviously, that was not 100% possible, because there were a couple of guarantees especially given. So now into the future, there will be many things that has to be considered. Again, resolution will be a key element. What are the adjustments that has to be made of different elements in order to nevertheless have this opportunity? Another I already mentioned will be that the asset side of banks has to be prepared in such a way that much more can be used as collateral with central banks. But that was limited. Many of the assets were not transferable. They could not be transferred because of legal obstacles, and then they couldn't be used as a collateral. So if this is prepared on a much higher level, then obviously the flexibility to deal with situation would be approved without going into emergency law. This is something that is very important. And in that respect, we have also to take into account that the phenomenon of a bank run changed. So we saw now in the US, but also with Credit Suisse, the speed and the magnitude of the bank run that exceeded everything that was seen so far. So with the outflow of deposits in the magnitude and the speed was never experienced before, and we have to take that into account. So this is a couple of important elements, and of course there will be other discussions about do we have enough competition in the banking sector, etc., so that the concentration risk are limited. But again here, I think it's very important that we look at that very carefully before we draw all premature conclusions. And size per se is not something that is completely informative. It depends really also on the business model and on the collateral that is available, on the way banks can be supervised, etc. So all these things will matter, and we have to take that into account in order to make sure that the banking industry or financial stability can put at the level that is necessary, but nevertheless that the banking industry can provide the services that are necessary, that the economy can function also in the future sufficiently good.
After the last financial crisis, equity requirements, capital requirements for banks have been increased. Now, before Credit Suisse ran into this crisis, it had about approximately 5.5%. The leverage ratio was about 5.5% of the balance sheet. Now, if we think about why bank runs occur, it's usually concern that the people do not get their money back, right? Eventually, that's why they run, because they want to be not the last one that's there, because the last one is not being paid out. So if people could be confident enough that the capital of the bank is really solvent, they would probably not run. Is 5.5% enough to give depositors that kind of confidence?
Mm-hmm. Well, you raise a very important point, and Swiss National Bank was always of the view that capital is important. Not only the level of capital, but also not only the level of regulatory capital, but also the perceived capital by markets, and the capability of banks to raise capital in case they need capital. So I do not go into the discussion whether 5.5 is right or low, but the level of capital is important, and we have to look at that very carefully also for the future. And on the other hand, we have also to make sure that banks can act as banks. So when you go to extreme numbers, then obviously the way they can provide loans to the economy, to households and firms, could also be harmed. So I think these are things that has to be balanced and has to be viewed on a, I think, more comprehensive perspective. And it's not only the level of capital. What we saw now is with Credit Suisse, it was really that the profitability of the business model was put into question. So if you look at the regulatory capital, both from the leverage ratio point of view and the risk-weighted point of view, especially how it was measured from a regulatory point of view, they fulfilled all these requirements, but nevertheless they lost confidence because the profitability of the business model was not anymore ensured, and that created then tensions in a very fragile environment, given the banking crisis in the US and given other elements that were around at that time in March.
I'm sure you have more questions on this topic for later, but before we go to the open question part, I would like to ask Amanda Sinnecker onto the panel. She is a member of the International Students Committee of the Symposium and is our student representative here on the panel, and she will now ask Professor Jordan some questions.
Yeah, a warm welcome from my side. My name is Amanda Sinnecker. I'm part of the 52nd International Students Committee. We are organizing this year's St.Gallen Symposium. I'm really proud to be here today and see all of you come to St.Gallen for this special event. And it's my pleasure to now practice what we preach, which is intergenerational dialogue. And I'm excited to now ask the next generation's questions to you. So I myself am a student at the University of St.Gallen studying business administration, and I would like to start off with a question on leadership. As you already touched on the UBS Credit Suisse merger, you were directly involved in managing some of the most severe crises in the Swiss financial system. And you already touched on second round effects, but when we put that further, in such a high-speed, high-pressure scenario, how do you balance the need for immediate action, immediate decisions, but then also considering long-term consequences, and what specific factors do you take into account when making those decisions?
Well, this is really a very good question, but also not an easy one to answer. And I say, well, we have some experience now with difficult situations and taking decisions. We have always to decide under uncertainty. So we do not know exactly what is the outcome. We often do not even know the complete situation. Some of the data often is only published later, so it's sometimes difficult to have a clear view on the given situation. So we have to decide always under uncertainty. And there you have to make kind of a cost-benefit analysis. You have to look at the different options. And then often all options are not ideal. So that with every option you have negative points. And some people will stress especially those negative points, or they will then stress the negative points of another options. And you have to come up with a decision where you are convinced that this is the best solution. And as a central bank, we always have also a longer term view. So we know that we have to deal with the situation, but we are also, of course, concerned about the medium to long term impact of a certain decisions. So with respect now to the situation we had in March, so that was really something where we had to find a solution immediately, because we knew without solution on this Sunday evening, most likely we would have had a financial crisis on Monday morning. Credit Suisse would not have been in a position to make payments that would have triggered bankruptcy and would have then created a big, really a crisis in Switzerland. People would not have access to deposits, could not renew loans, etc. And that could have been the first domino piece of an international financial crisis. And you have to be aware of those circumstances or of those consequences. And as often, you have to make a decision where you know that there will be a lot of criticism, there will be not everybody will be happy, but you cannot avoid taking a decision. So you are forced to take these decisions, and you have to do that to the best you can. This decision was not only taken by the Swiss National Bank, so that was then, of course, a common work between the Federal Council, the Swiss government, FINMA, the Swiss National Bank.
Mm-hmm. Yeah, especially when, well, as you said, it's a high-pressure scenario you needed to decide on Sunday. And when looking at this tension between short and long term, there's a certain accountability when it comes to that decision. So how do you maintain that accountability when you have made a decision over the long time? And what steps can you take to ensure that this decision remains the right one?
Mm-hmm. Well, you can never be sure whether it's the right one or the wrong one. Some decisions you can adjust, others are final. I think you made a very important point about accountability. So I think all the decisions you make as a central bank, but obviously also when the government takes decision as it did in the past, we have to explain it to the public, we have to explain it to the politics, etc. And then we have to explain exactly what were, I think, was the basis for those the decisions. And then I think this is very important for the accountability. But given the fact that you take decisions under uncertainty, it's never clear whether the decision is the optimal in the medium to long term. And often in monetary policy, you have to adjust then your policy. So this is also something where it's possible. Often it's better to take gradual decisions. So just to come back to monetary policy, we know there's an inflationary situation, and we have to address that. So we didn't increase rates from minus 75 basis points in one step to 5%, because maybe that would have been optimal, and the inflation would have gone immediately back to 2%. But there was a big risk that this is not optimal, and you do not exactly know how the economy is reacting. So there you take a more gradual approach. You know exactly the direction, you make a first step, and then you readjust your policy. This is not always possible. So with Credit Suisse, you had to make one decision, and you couldn't go in a gradual way on that weekend. But of course, these are major decisions. And I think the point I answered that before, it was really the question whether we take the risk having a financial crisis or not. And you have to make this cost-benefit analysis. And then you know not every decision may be not disputed in the future, but you would have completely different discussions when you you do not have the courage to take this decision, and then you have a financial crisis, and you explain, well, we didn't like emergency law, we didn't take the privilege in bankruptcy case, and because of that we accepted to have a big financial crisis, and all the damage for the Swiss economy is less a problem, just that we could stick to the fact that we take always the same collateral. I think these are the relevant discussions. This is the cost-benefit analysis at that time, and sometimes you cannot have just very nice instruments. You have to deal with the situation, and I think it is extremely important that the focus of the discussion goes really on what would have been the alternative and what would be the discussion if the decision were not taken at the right time, and Switzerland and the global economy and the financial center would go into a big crisis.
Yeah, exactly. And then when we go back to generational impact, what would this financial crisis, if you hadn't reacted in this way, would mean for the next generations? This is also to consider, exactly. Going maybe to the next topic, sustainability, a very popular topic in our generation. The Swiss National Bank's membership in the Network for Greening the Financial System shows a clear interest in long-term thinking. At the same time, there's a controversial debate on the role of a central bank in the transition towards a more sustainable economy. And, well, how can and maybe should central banks leverage their influence to drive systemic change towards sustainability? And what are concrete steps that you are taking to maybe promote sustainable finance within your organization, but then also beyond, as you do have a certain influence as a central bank?
Well, this is a very important question. And I'm deeply convinced that the biggest contribution a central bank, and especially the Swiss National Bank, can make is by providing price stability over the medium to long run. This creates an environment where the economy and politics can act on their responsibility much better compared to a situation where we have high and volatile inflation. So when we do not deliver on the main mandate, on the core mandate, then neither the economy nor politics can really deliver on those issues. So this is very important. Another element is we take all the impact on climate change, etc., into consideration with respect on our mandate. So what does that mean? How can we achieve our mandate, given maybe changes here as well? But we have also to be very careful that we do not take decisions that a central bank has no mandate, and that we enlarge the mandate, kind of a mission creep, and where we do not have the right instruments to address those issues. I think this is an important and a delicate question, and I'm deeply convinced that central banks should really achieve or deliver on their main core mandate, and this is a contribution that everybody else, the economy and politics, are then in a position to do their best, so in order to achieve sustainability. So our main contribution to sustainability is really delivering on the core mandate.
So you lay the foundation for other institutions to then have the right circumstances to do the proper,
exactly,
to take the proper steps. Yeah. Well, maybe building up to that, I would like to come to a topic that is very near and dear to my heart, and also fits very well with the 125-year anniversary of the University of St.Gallen, which is education. Specifically monetary literacy. I think monetary literacy is extremely relevant in today's complex world, as it allows individuals to make informed financial decisions and then also navigate changes in monetary policy that are taken by central banks. However, many people, particularly the younger generation, maybe lack an understanding of how monetary policy works and its impact on their financial well-being. It is therefore, in my opinion, important for institutions, maybe such as central banks and universities, to promote monetary literacy, to help people better understand what you're doing at the Swiss National Bank, basically. So how can universities work with central banks to kind of enhance this monetary literacy education for people with diverse backgrounds, also people that do not have access to higher education, that are usually the ones that maybe lack this monetary literacy, and what resources are available to facilitate this process?
Well, this is a very important point, and I completely share your view that economic literacy is extremely important for the population at large. And well, we do a couple of things, and of course you can never do enough in that respect. So first of all, we try to explain our monetary policy, hopefully in a way that most people can understand it, what it means, that we start by explaining the relevance of price stability, and then when we take monetary policy decisions, we always can improve, but we try in our communication to really address different audiences in a way that they can understand what we are doing and why we are doing and why it's important that we are taking those decisions. This is basically the different outlets that we have, from our web page to the publication, etc. But this is something that is important. We also have many appearances at universities, but also in different cities we go to talk to people when there is an interest. My colleagues, myself, but many of our economists do the same, especially with the ambition to explain our monetary policy. Of course, this is a lot of work, but we should continue to do that. It's not always really easy to do it, but we have some ambition to do it in that way. I guess it's also important that the topic of economics and monetary policy is something that is part of the curriculum at universities in economics. Many of our economists also go to universities as lecturer and explain the functioning of monetary policy. It's also a service that we are providing from the Swiss National Bank, so we encourage our economists, if they have the opportunity, to do this kind of lectures at universities. But it's also important that at secondary schools, economics is something that is a topic. And there we have a program, it's called Economics, where we provide teachers material so that they can use that material in order to make their classes attractive and easy to understand. So we are giving classes to teachers and we are providing that material. Economics is called, but it's free for everybody. You can have also a look at our homepage. And teachers appreciate these economics tools a lot. This is available in the French part, in the Ticino part, and in the German part, so we are providing that everywhere. So this is something that is very important. And I believe for financial literacy also it's important that in the media, from radio to television, but also in the newspapers, we have enough space that people can read about economic issues and on a daily basis, so that their interest in that matter remains high.
Yeah, and I mean, in a way, you're also promoting monetary literacy right now by sitting here and talking to us. Yeah.
A little bit,
Thank you very much to Amanda Sinnecker for her questions. I can say, on this topic that the University of St.Gallen has a very regular exchange with the Swiss National Bank, right? And we have also quite a few people from the National Bank, coming to us and teaching in our programs. So this is working very well. And also thank you very much to the Swiss National Bank to that exchange. I think this is very mutually beneficial. I would like to open the floor now to a general discussion, and I already see very many hands up. So we would like to start right there. Yep, please.
Yeah, so my name is Professor Russell Naker. I advise financial institutions. I've got some bad news. You had the Swiss franc. You don't have it anymore. There's a fundamental sea change in how people view the Swiss franc because the government of Switzerland has overrun and overruled private sector contract in this bailout. It's a fundamental shift in how people view your currency. It was the de facto reserve currency of the private sector along with gold, and that's gone. So my first question is, how are you going to manage the decline in the role of the Swiss franc at what has been a private sector reserve currency, because it's gone. The second one is the intergenerational discussion has been around inflation, but not debt and asset prices. The level of nominal rates has had huge impacts on debt, huge impacts on asset prices. Your ultimate collateral is the Swiss residential property market. Your job now is to ensure those prices don't come down. So your job is to lock in the wealth inequality in Switzerland. Because if residential property prices come down in Switzerland, the banking system truly is in a mess, and so is the Swiss National Bank. So those are my two questions for you.
Well, you may not be surprised that I do not fully share your views. Well, the Swiss franc remains an important currency as long as the Swiss National Bank keeps inflation low and guarantees the value of the Swiss franc. And I do not share the view that given the way, I assume that you are alluding to the 81 issues. I think the 81 issue, the legal setup was very clear. Both the government and FINMA looked at that very carefully, and it is not something where the investor can say it was not foreseen to be used under such circumstances. And we did not see so far any impact on the exchange rate since we have had the Credit Suisse UBS merger. So I'm confident that as long as the quality of the currency remains, the Swiss franc will be considered as an important currency, and the future will tell us whether this remains this way. Your second question was?
Well, it was about the nominal rates, residential property prices, the role that central bankers have played in generating this intergenerational wealth distribution that we have. Which we haven't discussed yet. And then they sort of added on to that, given your loan to the Swiss banking system, aren't you inherently interested in keeping the price of residential property up and not allowing a more fair and equal distribution of residential property?
Well, I disagree here again. So we have no target for the value of the Swiss property. It would make no sense for a central bank to target the value of the real estate property in general. So we know when we have big swifts in interest rates, especially also real interest rate, that has a big impact on the valuation. So we observed over many years the decline in interest rates, both in nominal and real terms. There are structural factors that can explain that. Demography is one, but there are others as well. So if you look from the 80s to a couple of years ago, we had a sharp decline, not only in Switzerland, everywhere. And the response to that is obviously a change in the valuation of financial assets. We saw that in equity. We saw it again in real estate. So for the banks in Switzerland, they have to be aware that there is a possibility when financial conditions change, that the valuation of their collateral also change. This is a reason why we have also regulation on that. They provide mortgages only when the mortgage owner is capable to afford up to 5% interest rates. They do not finance 100%, but rather only 80 and less percent of the house price. All these measures should then allow also the banking system to absorb some losses in the valuation of the property. But the goal a central bank should have is really price stability. And if we say, well, we have to ensure that certain assets prices are fixed so that mortgages can keep their value, I think we would be on the wrong foot. We have to ensure general price stability, but the valuation of assets can go up and down. And this is why we discussed it before. The value of equity, both for house owners, but also in the banking system, remains as very important as buffers. So the buffers have to absorb valuation changes. And we know when you buy a house today and interest rates are very low, and maybe interest rates go up a lot, the valuation of the house can come down. And the buyer of the house has to be aware of that. And this is a key reason why the bank should not finance 100% of the house prices, but only less than late 80%. But we have to make sure that we do not oversteer in the economy, and the economy has to adjust to different interest rates, real interest rates, and to different conditions. And the central banks, but economic policy in general, should not absorb any of these changes, especially if they affect relative prices. Not sure whether you are convinced about those answers, but I think these are extremely important elements for conducting a sensible monetary policy.
Thank you. Former deputy governor from central bank, and name is Pentti Hakkarainen. First, I could start by praising the work of Swiss central bank in case of Credit Suisse. It was swiftly solved, and it calmed down all that concern market had, and really chapeau to that. Well done. My question relates to mandate and work of central banks here in Switzerland and in other economies as well. Price stability is one, and then financial market stability another. Is there a trade-off? Now fighting against inflation, major central banks are raising rates, and then that is potentially causing instability in financial markets. How do you manage it? What is your advice to other central banks if you're not commenting on what takes place here in Switzerland? No. Thank you.
Well, thank you very much. It's a very important question, and I think it's important to distinguish between short-term and long-term trade-offs. I think in the long term there is no trade-off. There could be a trade-off in the short term as we see it now, but we have also to take into account what would it mean if monetary policy is not adjusted to higher inflation. And they say, well, because of financial stability risks, we do not take the appropriate decisions today. We will take it later, and inflation may increase further, and then you take even more extreme decisions later, and you create the same challenges and problems for financial stability maybe in the future. So I think we have to have this very clear view. Obviously, when you increase rates, some financial firms could become a little bit under tensions, and it would be more difficult. But the real question is always, when you postpone necessary decisions today, what does that mean for the future? It's exactly the intra-temporal perspective here. And when central banks fear to address the problem today for certain financial stability risks, they may end up in a situation where fighting inflation could cause even more troubles on that front as well. And just to give you an example from Switzerland, so we had in the late 80s, early 90s, inflation came up, and the reaction of the Swiss National Bank was then maybe a little bit too late, but it was relatively high, and then the impact was also strong. So I think to figure out what is the appropriate timing is extremely important, and it is often not the best idea to postpone a certain decision because you fear that today it could also be considered as negative by some either institutions or by some of the public. I think here we have to have really this intertemporal view, and postponing decisions could also mean that the problems become bigger in the future. But you are completely right. From time to time you have these kind of tensions, and you have to have a cost-benefit analysis that leads you to the best possible decision.
Okay, next question. Yep. Yeah, you.
Thank you. My name is Sophie Newber. I work in M&A and FIG at JP Morgan. And my question is shifting to a new and equally important topic from the perspective of monetary policy, but also future generations. And it's on the central bank digital currencies. I'd be very curious to hear your opinion on what is the cost benefit of CBDCs in the context of increasing efficiency of monetary policy, whether you think it's feasible as a new type of currency of the Swiss franc going forward? And if so, how would that disrupt the commercial banking sector? And given that it increases the cost of capital, most likely an outflow of deposits from commercial banks, yeah, how do you see the central bank working with the commercial banking sector to facilitate and prepare for that potential innovation? Thank you.
Well, this is also a very important issue, and the Swiss National Bank is conducting a series of experiments with central bank digital currencies. So it's the general topic that we are really investigating a lot, and maybe I can summarize a little bit the view that we have at this moment. And I think you can distinguish between a retail CBDC for the public at large or a wholesale that is then used by the banking system. We see some potential benefit for the wholesale, but at the moment, I have to stress at the moment, we do not really see the use case for a retail CBDC. And for the wholesale, it's really a question whether you can make the financial system more efficient and whether it's necessary to provide a wholesale CBDC in financial market infrastructure in order to achieve those efficiency gains. This is an open question. Experiments will show over time whether this is the case or not. With respect to the retail CBDC, this is the more tricky part, because then you really change the access to the central bank for the public at large. So it's really a question about how you structure your financial system, and to some extent you can compete with commercial banks. It depends a little bit how you define exactly the access to CBDC. Given the situation, concrete situation in Switzerland, we do not really see a benefit for the public at large or for the economy using a CBDC at the moment, because the payment system that we have is extremely efficient. It is also improved on a constant basis. So people have access to cash, they have access to mobile payment, they have access to e-banking. You can do whatever you want in a very efficient way. So what would be the use case or the additional benefit to give a central bank a digital currency to the public at large? So this is the key question. And obviously, given the speed of bank runs that we saw now in the US, but also in Switzerland, I think it's an important element that everybody has to consider when they change the access to central bank money in a fundamental way. And it could then not be that you have the opportunity to easily have a bank run on a single bank. It could also then in a way facilitate the run on the system as a whole. And I think these are things where we have to be very sure that we go into the right direction before we change the system and make it less safe than it is today, especially when there is no use case, no obvious use case under those in the current situation.
Can I just raise my voice?
First, Lord Griffith first, and then you.
Oh, okay. First of all, I'd like to say, Mr. Governor, to say thank you for the clarity with which you described the way you conduct policy in the Swiss National Bank. It was very clear. And also, congratulations on keeping the rate of inflation so low. Compared to the US or the Euro, ECB or the Bank of England, I mean, you've been remarkably successful. I think that one issue, I sit on the Economic Affairs Committee in the House of Lords, and we are looking at the future of the central bank, the Bank of England. And one issue which comes up with us is the following. If you look at inflations, we can handle a little inflation, 4-5%, that's okay. But when inflation has really taken off, it's always been associated with wars. It was the French Revolution and the Napoleonic Wars, then the First World War, the Second World War, the Vietnam War, when the pound was tied to the dollar, and I think the war against COVID, because the restrictions we introduced against COVID were more than we introduced in either the First or the Second World War. And at present, what you see as a result of that is a tremendous potential increase in public spending. And the politicians are under great pressure for increased defense spending, but also for increased health spending, resiliency against pandemics, and so on. And the question raised is, what would it take for a bank like the Bank of England ultimately to give way in the way that the old German Deutsche Bank did, or the Central Bank of Germany, or any other country, which has allowed inflation, in the 70s it went to 27% in Britain, but assuming it went to hyperinflation, what guarantee do you have in Switzerland that if the politicians were under tremendous pressure to increase spending, and they found it very difficult to raise taxes, and they found it very difficult to raise money from abroad, what guarantee do you have that your position as the chairman of the board would be independent, and that you had the power, the authority to bring it back?
Well, your point is, I think, extremely important. So it really addresses the questions of fiscal dominance and whether central bank can remain independent. Now in Switzerland, independence, the governance is relatively strong because independence is written in the constitution of Switzerland. So the constitution can also be changed, but it's much more difficult compared to just changing a law. So the constitution, the Swiss constitution says the Swiss National Bank acts as an independent central bank and conducts a monetary policy in the interest of the country as a whole, and that means price stability. So I say fiscal dominance is really a threat, and central banks have to make sure that they remain independent and that they do not give in to finance government expenses. When they start doing that, then as I say, fighting inflation becomes extremely difficult. And given the impression that the central bank is ready to finance the public spending, then obviously you are already in a difficult position. So I think this is a very important element. In Switzerland, luckily, the finances of the government, also the cantons and the communities, are in general in a healthy state. So our debt level is much lower compared to many other countries. This is also due because we have a so-called debt break in the constitution, that the parliament and the government are forced to balance the budget over a cycle so that they cannot increase the level of debt easily. Obviously, COVID was an exception, but also there, the increase in the debt remained in a certain proportion. But having sound fiscal policy, I think not only that unsound fiscal policy could be a threat to monetary policy, as it could be also a threat to the country in the medium to long term, because it harms the room of maneuver to react to certain shocks in the future. So I think both fiscal soundness and price stability are prerequisites for, I think, a long-term, stable economic policy and growth, and especially when you are talking about intergenerational effects. Both are a necessity, I think, to have also a competitive country in the long run when you follow reasonable policies.
Okay, now it's your turn.
Thank you very much. Andreas Fischer, Chief Investment Officer at Zurich Insurance, and even more importantly, proud father of a daughter in the organization committee of this great symposium. After all these complex questions, I have a very easy one. What do you do, Mr. Jordan, if the equity turns negative of SNB? Can you elaborate a bit what that means to you as the CEO of SNB and to us as inhabitants of Switzerland?
Well, this is a question that was raised already a couple of times, because there were were possibilities that the Swiss National Bank would go into negative equity. I think we try everything to avoid that. We have the ambition to maintain a healthy equity position at the Swiss National Bank, but obviously, because we have a big balance sheet and we are exposed to exchange rate shocks, equity shocks, and interest rate shocks, we can also have large fluctuations in the value of our equity. And Professor Ammann already mentioned it, that we suffered last year a big loss, but luckily we still have a positive equity. So when the Swiss National Bank would suffer a further loss and equity became negative, that would not mean that monetary policy would be less effective than today. So we could continue with exactly the same monetary policy with the aim of maintaining price stability. But it would also mean that we have to build up in the future, again, the necessary equity that the Swiss National Bank first returns back into a territory of positive equity, and then build up the necessary equity that we get to a reasonable amount of equity. And that also means that the period where the Swiss National Bank would not be in a position to pay a dividend or a profit distribution to the government could be longer. I think that would be the immediate consequence, that the Swiss National Bank would then not be in a position, as we are today, not paying dividends and profit distribution to the government. And the bigger the shock, the lower the equity, the longer it takes, again, to be in a position to pay out dividends and profit distribution. So these are the immediate consequences of having negative equity. But the conduct of monetary policy would not be changed, also not the possibility of the Swiss National Bank. But of course, we prefer much more to be in a position with a positive equity, with a sufficient equity, even in a situation where we have a positive reserve of paying dividends and distribution to the cantons and the governments. But compared to a situation where we are now, where this reserve is negative, and of course much more to a situation where the equity is even negative. So this is a little bit in a nutshell the situation. No immediate impact on policy, but of course an impact on dividends and possibility to pay dividends and profit distributions, and of course something that has to be changed and over time by accumulating further profits.
You have time
Thank
for
you.
one more last question.
Thank you. I'm Sudhir Jalan from India, and naturally my question would take you a totally different field. See, the circumstances in India are very different, and so are the expectations. We are aspiring, and we have done it always, 6 to 8% rate of growth, which in today's circumstances is laudable. Probably India is one of the fastest developing countries. But we have maintained an inflation target of about 5%. And an interest rate is about 1.5% higher than that. That has allowed more deposits also to come in, and there is a fund flow also into the country. And the exchange depreciation is average 3% per year. And it has worked very well for us. I would like to have your views on the same.
Well, I have to say, your governor is a very good friend of mine. So Governor Das is an excellent governor and a remarkable personality, and we exchange views regularly. By the way, India is has the presidency of the G20 this year, and I had the chance to visit India a couple of times now. And I cannot really give advice to India, but as you explained it, it seems that the policy is done in a very sensible way. And as you mentioned, India grows at a very high number, has a high potential. And it's also, I think you have to make a distinction between an advanced economy like Switzerland, where growth is much lower. So potential growth in Switzerland is something between 1.5 and 2%, and in India it's much higher, and an emerging market like India. So these are two different circumstances and conditions, and monetary policy has to be a little bit different. But all you mentioned now, alluded to, I think is a proof that the policy here is a very successful one as well. Thanks.
All right, well, thank you very much. We have to look at the time and should come to a close. I would like to thank Amanda Sinnecker for her questions. Thank you very much for your contribution. I would like to thank ThomasJ.Jordan for joining us again here today for this interesting discussion. I would like to thank all the organizers who made this event possible, but most of all, I would like to thank you, the participants who joined us today. I wish you a very good remainder of the symposium, very many good discussions. Thank you very much for joining us today.